Hi, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas, and I teach intermediate accounting 1 and 2, and even principles of accounting from time to time. And I have my lectures all out on YouTube, including this one eventually after I finish recording this. And the purpose of these videos is primarily for my UNT accounting students. However, I started publishing them on YouTube in the middle of COVID, and I found that a lot of other people found them interesting, but that's kind of a side benefit. And I do not advertise them, not going to be a YouTube star by any means teaching accounting, but if you run across these and you like these lectures, more power to you. And please, you can send me an email if you like. It's roy.rumbo@unt.edu. Last name is spelled RUMBOUGH, and would love to hear from you. I do get comments on some of the lectures. So with that, today's lecture is the very first lecture for Intermediate Accounting 1, Chapter 1 from the textbook we use, which is McGraw-Hill's Intermediate Accounting Textbook by Spiceland, Nelson, and Thomas. It's, by the way, and I'm just going to continue to plug them in every video. Number one, give credit because I use their materials in these videos, but it is just an exceptional textbook, and I highly recommend that its use in other programs. I'm sure there's other good textbooks, but I really do love this textbook, and I have enjoyed teaching from it. So again, after giving credit to them, I'm going to get started here. This is, again, the very first chapter for Intermediate Accounting 1, and we're going to talk about kind of the environment, the framework, if you will, for accounting rules. If you saw my introductory lecture for intermediate accounting, what we do in accounting is we measure with debits and credits, and we report. But somewhere there's got to be a set of rules that we follow, and we're going to see all of that in this chapter. And some kind of, where do these rules come from? What's kind of the framework, the conceptual framework to develop these rules. And so we're going to talk about that, and that's developed over time, and it's developed in different ways throughout the world. But I would put the United States accounting system above almost all the others. It's just an exceptional framework. It's been a lot of time doing it, and it has supported our financial markets and the integrity of our financial markets. And so, which is a great, power of the United States comes a lot from its the financial markets and the liquidity there. And so accounting does play a very, very important role in that. And we'll get into that in this chapter. So why, accounting is got to provide useful information that will help people make decisions. And, I guess as I was talking about the United States, I was really good segue into this slide, foster a prosperous society. I mean, that sounds kind of, maybe corny there, if you will, but it is an important attribute for us. And so we have economic activity, and then there are shades of gray around that, which we have to bring in critical thinking and accounting judgments to play here. And we process this so we can filter it and find a way to report information so it'll be useful to people who are making decisions on that. And so that's really important. In fact, in accounting, we do have two kind of big fields of accounting. One is financial reporting, and that's what this course is about, is external reporting to others. But there's a whole nother field of accounting called management accounting, which is processing the information for people inside the company. Certified public accountants, happen to be one, is responsible more for the financial reporting side and the auditing side, which we'll get into. Certified management accountants, another certification, I happen to have that as well, and I've done that as well, is, how do we, kind of slice and dice these numbers on the financial statements to help users inside the company understand the numbers. So that's also really, really important. And one way I talk about management accounting, when I was a management accountant, is that we're deciding to say, hey, where is the company making money? We know what the total financial statement says, but what parts of the business or products are making money, or customers even are good and profitable customers for us, and which are not so profitable, which products are not faring so well. So it's digging deeper into the details of the financial information and helping internal users make decisions. So that's management accounting. This whole course is going to be on financial accounting, external financial. And who uses this? People who are investing in the business, people who are creditors, who are loaning money to the business, and maybe many other external users, the government, prospective employees. I definitely want to see the financial information before I go to work for a company. So how do we report all the measuring we're doing inside the company? It's through the financial statements. And here's 4 of the key financial statements. The balance sheet, that's the assets, the liabilities, and equity elements, point in time kind of measure. Income statement that measures revenues, what we're selling, minus the expenses, the cost to sell those things. And so it answers the question, are we making money? Is a company profitable? Statement of cash flows is a supplemental schedule that shows us how much cash the company is generating, how it's investing that cash, and then what's the source of the cash, is with debt or equity. And so that's also a very important statement. And finally, for owners, they care about this statement. It shows all the different components of equity and what's happening during the accounting period for that. And so financial reporting is nothing more than the process of providing the financial information to external users, versus management accounting is internal users. All right, so providers of financial information, this is important if you want to be an accountant. All these providers, they need accountants, right? Hey, profit-oriented companies who are selling things to make money for their owners and to create jobs maybe as well. Profit-oriented companies, non-for-profit entities, okay, governments, charitable organization, schools, they all need accountants. And so they're generating financial information, and even there could be household information, just think about your income tax return as a form of showing your income as individuals over the year, and that gets reported. So here, look at all the various and sundry users of that information. All people you would expect. So we talk about capital markets. Those are the markets that allow people to invest in the company efficiently. Think about the New York Stock Exchange that provides a listing of companies and their stock prices. It allows liquidity where people can buy and sell a company stock every second, every minute, all day long, at least from 9:30 to 4 p.m. Eastern, capital markets. And the corporations, they get capital from investors for ownership interests, and also they can borrow money. That could be from banks or as individual loans, or maybe bonds, which are publicly traded debt, almost like common stock. Hey, why do people provide capital to companies? They want to make money themselves. They want a fair return. They want that stock to grow in value and that company to grow in value by making a lot of money. And so what they're looking for, okay, number one, what's the rate of return in the past? Now they don't care, by the way, all these investors, they don't care about the past. They care about the future. But how the company's done in the past can be a good predictor of the future. I always say financial statements in total, income statement, balance sheet, especially the cash flow statement, they tell a story about the company. And that story helps you to predict the future. Now, if there's a high risk, we look at that story and it seems like serious risk, then we're going to a higher rate of return. I might be willing to invest in a new startup company. Maybe they're losing money now, a lot of risk, but maybe they can have a super high rate of return. Or, maybe a more stable company. I think of General Mills that makes cereal. It's less risky because people are always going to eat that cereal. And they have, maybe a lower rate of return, and they pay us very stable dividend every year. So I do like General Mills. And so here's a way of looking at a rate of return. Let's say you made $10,000 initial investment, you got $400 in dividends, but the stock price went up by $600. that would be a 10% return. So financial reporting, here are some things that we're going to have to think about. Hey, the amount of what we record and report on the balance sheet, income statement, cash flow statement, timing. This gets into, when do we recognize a revenue? Is that when someone orders a product from us? Is that when we deliver the product to them? Or is that when we receive the cash for that product? So a lot of the issues of intermediate accounting get back to timing. And I always say accounting is a lot about timing. When do we record things? And which financial statement do we put it in? This year's or next year's? And so, and certainly, there's always judgments and uncertainties we're going to have to deal with. Cash-based accounting, not going to spend a lot of time on that. Not acceptable for public companies, not allowed. Accrual-based accounting is required for all public companies. And even if I had a small private company, if I had one little store, I would still do accrual-based accounting because it measures things when they happen, not when the cash is paid or received. Because I want to record revenues when I have delivered the product and added value to my customer. That's when I want to record revenues. I want to record the expenses when they've occurred, not when I pay for them. And that therefore, when I look at revenues minus expenses, it's going to be an apples to apples basis. Revenues that happen and expenses that happen in the same accounting period. That's why we care that timing matters. And here's a good example of that. I'm not going to spend a lot of time on this, but here the company paid $60,000 for 3 years rent beginning in year one. So in cash basis, we would just subtract $60,000 in expense the first year, 0 in year 2 and 0 in year 3. What's the problem with that? Hey, that rent, that right to use that asset, it was good for 3 years. Whatever we paid that rent for, with a warehouse or a store or a restaurant location, whatever, that had provided benefits to us for all 3 years. Yet we recorded the expense in year 1. Now, if I look at this financial statement, knowing that all 3 years, it could be misleading. How would it be misleading? Well, it looks like this company lost $65,000 year 1, but made money year 2 and year 3. And I think, wow, what a great management team. They were losing money. They really turned it around in year 2 and year 3. Well, what's going to happen in year 4? They're going to have to pay another $60,000, unless they're just going to quit doing business. They want to continue on, right? So, there's something very misleading about that. And if you look at this, the next year is going to have a rent expense of some sort. So that's cash-based accounting. Now look what we do in accrual-based accounting. What we do, and we'll see this gets debited to prepaid expense, and we expense that $60,000 over each year, the year that we're using it. So there's a matching, if you will, of the cost of that rent with the revenues that we produced with that rent. And so look at this, 20, 20, 20. Now look at this. It's a very stable business. It's making 20 this year, 20 in year 2, 20 in year 3. But they're probably gonna make it in year 4, 20, right? And so this is not a misleading financial statement. I would say this company's not growing. So, it's almost too stable. Why aren't they growing more than just generating the same? But look at these two financial statements. Cash basis is giving you a misleading picture of result. It's not providing what we call, and we'll see it later, faithful representation of the numbers. It's not really relevant for good business decisions. This one is. This one tells the true story. And so accrual-based accounting is very important. Where do accounting rules come from? What do we call them? Let's start there. The rules come from what we call generally accepted accounting principles, GAAP. And you'll see this commonly referred to as GAAP. Does GAAP allow us to do this? What are the GAAP rules for this? And so there's significant set of rules. I think when I left Linux, I had they covered 4 books with small print, and that's what the GAAP was. Where does GAAP come from? Okay, in the U.S., here's the hierarchy of standard setting. Congress has the ultimate authority for the accounting rules, and they provide that to the Securities and Exchange Commission by law to implement those. However, the Securities and Exchange Commission has deferred to private sector organizations. And we've had 3 of those, the CAP, the APB, and then finally now the FASB has been around for almost 50 years now, the FASB. And this is the Financial Accounting Standards Board. Some of the rules that these previous organizations came up with still live on today and are part of GAAP. Now, the Securities and Exchange Commission influences the private sector, and there's a member of the Securities and Exchange Commission that will participate with the FASB as new rules are set. And Congress sometimes gets involved, but not, I would say, not in good ways, becomes very political. And so there was a time where the FASB wanted to expense all stock options in the 90s, and Congress was going crazy because they were being lobbied by all the .com businesses which are just giving away a lot of stock options at the time to their employees and executives that try to keep that from being expensed. However, really should have been expensed. It was a real expense of the businesses, but Congress stopped that back in the 90s, and that took the FASB time. And they, over time, I think around 2002 or 3, we finally, the rules were passed that stock options get expensed in the income statement. So those are the kind of things where Congress has got involved, but not in good ways, if you will. And so again, what you need to know, FASB sets the accounting rules. Who is the Securities and Exchange Commission? They were established after the 1929 crash, because there were a lot of companies selling their stock, and they didn't even have a company. They were just selling stock, and people were buying it. It was like a big bubble that burst in 1929. And there were some real business, but there were a lot of businesses that it was just total outright what we consider fraud today. And so Congress passed the 1933 and 1934 Securities Act, which applies to public companies today, and has some rules. So here's the CAP, Committee on Accounting Procedure from 1938 to 1959. Still they issued what's called ARBs, Accounting Research Bulletins, and then the Accounting Principles Board. They issue what's called APBO. Some of those are still good today and have been included in the current GAAP, and they were from 1959 to 1973. And then the FASB was created in 1973. Maybe less important, but still matters, the Emerging Issues Task Force was created in 1984. Because the FASB, it takes time to get a rule through the FASB. And sometimes companies, because of new types of transactions, maybe, or complexities, the EATF can pass some rules earlier than the FASB does their final rule. And then we have government accounting standards too that are done by the GASB, the Government Accounting Standards Board, because government accounting is different than private profit companies that are for profit. And so the FASB has codified all their pronouncements, and we call that the codification, and accounting standards codification, and we'll look at some of that in a minute. And every time they issue a new standard, it's called an ASU, an Accounting Standards Update. And that gets put back into the codification. And it may change some of the old rules. And we had big changes recently for revenue recognition and for leases. We had, it took the lease accounting standard, took 10 years to pass because there were a lot of complexity. And so the codification is organized in various topics with numbers around them, where, as you would think, assets first in the 300s, liabilities in the 400s, equity in the 500s, revenue in the 600s, and expenses in the 700s. So it is organized. Now, as I said before, there are different rules internationally than the US. and they are done by the International Accounting Standards Committee. And well, now they're done by the International Accounting Standards Board, IASB, and so they have their own reporting standards that are different than the FASB's, by the way, and we call that IFRS, International Financial Reporting Standards. And there was an attempt to try to converge the FASB's codification with the International Financial Reporting Standards, but it was too difficult. They couldn't get there from here. You would think it would be easy. It's just accounting rules, right? But there's a lot of emotion involved in this, and the same transaction might be accounted for. There are multiple alternative ways to do it, and sometimes they just could not come to terms with that. And so the convergence of international standards with the US standards by the FASB is that's gone. And that's important to know as an investor, because maybe you're investing in an international company to know they're following different rules. What are the differences? You might want to know that, and if you're here in Texas, Toyota is right down the road from me here in Plano, Texas. That's where their US headquarters are, and they hire a lot of accountants, and you better know their accounting may be different than the FASB's. So I'm not going to spend a lot of time on this. I think I would say is that the board, things get on their agenda. People ask them, they have quite a few things always on their agenda, and it takes time. Once they go through and they have staff that work on these pronouncements, the first thing they do is issue an exposure draft. And so as lease standard was changing for accounting for leases, they issued more than one exposure draft, 2 or 3 of them. When that exposure draft came out, the first one, myself and my staff were going through with a fine-tooth comb to understand what's the impact for our company. How are we going to go capture all the information we need to follow the rules? And I spent a lot of time in the first exposure draft. And some of it I didn't like, some of it I liked it. I went to training sessions on it. And then I realized, oh, they walked away from that one. And they had a second one and even a third one. By the way, by the second one, I said, okay, I'm just going to wait until they're done. And when they're done, that's when they issue an accounting standards update. And fortunately, on these really difficult ones to implement, they'll many times give you 1 or 2 years to make the changes required. And so lease accounting, I think they gave us almost 2 years. Some companies got 3 years, smaller companies. And so, main point of this slide, it is a very deliberate process. And both the users of the financial statements and the providers of the financial statement get a chance to comment on these, what they like or don't like about a new proposed rule. And that's why the exposure draft. By the way, this isn't like 1 page. I think the exposure draft for leases might have been 100 pages. And so there's a lot, again, devil's in the details on that. You don't know how it's going to impact you. So how do we get to high quality financial reporting? We have auditors, and that's the whole purpose of us having a CPA designation. These are people that, and they're licensed by the states, by the way. So I'm licensed in North Carolina, not in Texas, but a CPA, certification allows you to express an opinion on a set of financial statements. Now, for the large global companies, so what we call the big 4 accounting firms is 4 of these, and they are super large, and from my side, super powerful, and they have offices all over the world. Why? Because their companies that they're auditing are all over the world. At Lennox, our auditor was KPMG, one of the big 4, and they had a big room permanently on the 7th floor where I was in Richardson, Texas, and they were there almost all year. Now sometimes there would be 1 person in there, sometimes they have their team of 20 in there, and so all year they're either auditing or preparing to audit our financial statements. And so that relationship of the auditor could be somewhat adverse, right? Because I may have an accounting position, they don't like it, and then there's a lot of dialogue, right? Constructive dialogue. But I would say also, when I found an issue out in the field in one of our business units that maybe they're doing the accounting wrong, or there was a question about it, I immediately told them. It's not wait till you're in and audit that. I want them in early to discuss this and see what their thoughts are. And for new pronouncements like the lease standard or revenue recognition standard, we are talking with the auditor in detail about how we see the pronouncement, how it would apply to our facts and circumstances. And we've had a lot of issues where we had fraudulent accountants, Enron here in Texas and Houston, WorldCom. I mean, where what they were saying, they were cooking the books. Their information was wrong. Why did they have wrong information? They were trying to get their stock price to grow, increase, and they were providing financial statements that were inaccurate. I can't say it any other way. I believe WorldCom had a $10 billion expense that they classified as an asset, not expense, something really large that was on the financial statement. And so people who relied on that lost all their money because these stocks went bankrupt. And so people relied on that and they got sued, big time lawsuits. People went to jail in these as well. I don't know about Merck as much in Philadelphia, but people went to jail. The CFO, the corporate controller, even the CEO went to jail for the fraudulent financial statements. And these were such big fiascos that Congress got involved in around, this is probably from 2002 or 3, and they passed the Sarbanes-Oxley Act. And so the Sarbanes-Oxley Act, and the auditors, by the way, those companies, they were not good either. And so there was a lot, the Sarbanes-Oxley Act provided rules that now there's going to be oversight for those big public accounting firms. It's called the PCAOB that oversees and has, goes in and they audit the auditors, if you will, is one of the things they do. And we now have accountability for executives. They have to sign off that they've read the financial statements and that the internal controls in the business is good. And, the internal controls, that's a whole nother course, if you will, to make sure the proper internal controls. And there's just a lot of important rules that passed. But, for new accountants, many of you who are going to be accountants may work on what's called the Sarbanes-Oxley. Management had to have an opinion at the end of the accounting period that their internal controls were adequate. There is a lot of work to prove that all your processes have the appropriate internal controls. Now, this was section 404 of the Sarbanes-Oxley Act. So you'll many times hear, commonly used terms, the SOX 404. How's it going on SOX 404? Well, I'm an auditor. I'm going to be working on SOX 404 for XYZ company. And so there's a lot of work involved. Again, job security for accountants. And it's a good place for people to get started in the profession in internal audit. So in accounting, we have a lot of ethics, or the code of ethics, that's provided by all three of these organizations here. AICPA for certified public accountants, which I'm a CPA. For management accountants, we have the Institute of Management Accountants. And for internal audits, there's another one. There's another certification to CIA, Certified Internal Auditor. And each one of these has a code of ethics. And so my CPA, one of the things I think about, there's a lot about CPA ethics, the ethics for CPAs to have integrity and even have the appearance of integrity, So, it's not just real integrity, but even in all aspects that you have the right level of objectivity in doing accounting, not just trying to come up with the numbers that you want or the company wants, but to come up with the right numbers done with transparency, with integrity, with following the right set of rules. And sometimes I will say, it sounds easy to say you have integrity, but I've been in a circumstance where, it took courage, took real courage to take a big charge. And no one, the CEO, even my boss, CFO, were never happy with big charges. And so sometimes it took courage to do the right thing. And so I value my integrity as a CPA. And so this is, you take an ethical course, it's all about the facts, the situation, identify the ethical issue, who's going to care about it, think about look at alternative course of actions, and then, and make the right decision. So I'm not going to spend a lot of time on that. And we're moving to another area, which is the conceptual framework. And this is a really important area to think about. And I do refer to it in a lot of my videos for Intermediate Accounting 1 and 2, because these are really important. As you think about the rules, there's different and alternative paths each rule could go down. Think about all those exposure drafts for lease accounting and how much they changed every time they came out. Well, everything gets back to the conceptual framework. It's almost like the Constitution, if you will, like the United States Constitution. And it guides how we're going to think about that. It provides structure and direction to financial reporting. And so conceptual framework, and we're going to get into this in a minute, but this is the overview here. Unfortunately for accounting students in Intermediate 1, there's just a lot of memorization here and understand these terms, because if you're in my class, you're gonna get a lot of multiple choice around these. So you really have to understand, memorize these concepts, which is kind of hard when you've never even really been into the business world. And so, let's talk about number one here, the objective decision. And what we're talking about right now, I'm just going to switch back here. We're going to talk about each one of these. So let's talk about qualitative characteristics that help decision making. What are the qualitative characteristics we should have for accounting? And so it needs to be useful for people making decisions. And so there's two primary areas we're going to think about for the qualitative characteristics. Is the information we're providing relevant? And does it provide a faithful representation? Does it reflect what's happening in the business? So let's talk about relevance. Well, does it have predictive value? By looking at this, does it help me predict the future? If we go back to that earlier slide on the cash basis accounting, where we booked a $65,000 expense in the first year and zero in year two, well, that cash-based financial statement we looked at did not predict the future very well. The accrual-based one, where we put 20 in each year, that had good predictive value. Confirmatory value, does it confirm what's really going on in the business? Does it confirm the appropriate trends? And we're going to care about materiality. What does materiality mean? We're not going to track every single penny, because if we're one penny off, no one's going to care, right? And if you're in $100 billion business, maybe $1 million is like that penny. It may not be material. If you're in a $10 million business, $1 million's very material. So we're going to think about, in terms of relevance, we want to make sure we account for things at the right level of materiality. And one of the issues there, and we'll get into one of the constraints, is the cost benefit, because we're all right here. I'm sorry. It's got to be cost effective. Go chase and capture all of that data. So we're going to think in terms of materiality. Does it faithfully represent what's going in the business? Is the information complete? Is it neutral, objective? Is it error-free, free from error? It's not going to be correct down to the last penny, I'll tell you that. Is it free from error on a material basis? Let's think about completeness here, because this is something that I've had a lot of dialogue with my auditors about back at Lennox. It's been a big conversation, big topic of conversation over the last few years. Let's think about leases. We had to go put, Lennox had to put all the leases on the balance sheet. They had not been on the balance sheet all year. And it depended on the contractual terms of the lease. Well, Lennox is a $4 billion business operating in 20, 25 countries. And we've got to go find every single lease for every copier, forklift, computer, all over the entire world. And if we miss one, then the information is not complete, right? And so you've got to make sure you have the complete set of information. so that your information is free from error, that has a faithful representation of the company. If it's incomplete, it's not a faithful representation. And so that was a challenge. Now, for me, as a corporate controller, this was a really difficult concept because I couldn't know about what I didn't know about. The auditors would say, how do you know you have all the leases? How do you know you have, and this could be any topic that we're looking at, how do you know that your report is complete? You know, for salary expense, have you captured all the employees in that salary expense? How do you know it's complete? Well, I got to, you know, challenge myself in our business. If I have an integrity, if I know about it, I'm recording it. But how do I know what I don't know? You know, so that was a bit of a challenge around completeness. How do we make sure? One of the ways we did that is we had a checklist for people around the world to say, you know, have you looked at every single lease? All these leases count. So part of it is education and awareness, and to make people at the lowest level sign off that they've captured everything. And many times stuff would come back to us. Yeah, we missed this, sorry. When people have to sign their name to something, the controller in the local business and maybe the president, you know, you sometimes get a different answer because they know if they sign off wrong, you know, and later we find out that there was something there, they could easily lose their job. And maybe in some cases, if it was intentional, it could be illegal. And also for faithful representation, we can't book just what we want the answer to be. You know, operational managers, they do not like expenses. They want high profit. You know, so, and we too, as accountants, we're paid bonuses on profits, but we have to forget that. We have to be neutral and objective. And then down here at the bottom, some really important things for decision usefulness. Is the information consistent? Are we following the same rules this year that we followed last year? Consistency was a big deal for me. And, you know, and people always come because they wanted a different answer and say, hey, I want to change the accounting way, because they sometimes could have multiple ways that would be allowed in accounting, even in GAAP. And I say, no, not changing the rules. You got to follow what we followed last year. You can't change, you know, the policy of how we account for something based on you like the answer this year and change it back again next year. So consistency is very important. Is it verifiable? You know, we record assets for what we pay for those assets. Well, I can pull an invoice and see that. Is it timely? And this is really important for decision usefulness, because if I give you the income statement 2 years from now, well, it's too late, right? And so for the Securities and Exchange Commission on quarterly financials, I think you have 35 days to do a quarterly financial and 60 days to file a full year. And so they consider that timely, and it does take a lot of time to pull all this information together at the end of the year. And so timeliness matters. Because if you're after that 60 days, you know, it may not be relevant information. Facts and circumstance might change. And is it understandable? Because we're providing the users who are not accountants, and is it understandable information? So a lot of dialogue around this. You know, this is something you need to know. And for the CPA exam, you get tested on these. And so this is a good place to go look, not just rely on my explanation here, get into the textbook. What elements do we care about here? Those are things we would think about: assets, liabilities, equity, distributions to owner, revenues. These are the elements of the financial statements that is around, the framework surrounds these elements and how we're going to account for them. And so here's 4 what we call underlying assumptions, you know, that we are accounting for one economic entity. There may be multiple subsidiaries, but we want to make sure we're doing accounting for, we don't get mixed up and confused. And how would that happen? You know, a lot of times companies start joint ventures. Company A and Company B, they create a joint venture. So that's where it matters. Which company am I doing the financial statements for? Company A, Company B, or this new joint venture, Company C? And so you have to really be clear and separate out the company that you're doing the accounting for. And so they have to be, we are measuring events specifically with that economic entity. This is really important if you think about a sole proprietorship, that it's sometimes to be easy to mix up the personal expenses of the owner with the company. You don't want to do that. If banks are loaning that company money, they don't want to see the personal expenses, someone buying their personal house. There's going to be a separation there. So that's the economic entity. Going concern anticipates that the business is going to continue to operate, because some of our accounting is going to depend on if we have a multi-use asset, a long-term asset, and we're going to record the expense over that over time, we got to assume that entity is going to continue to exist. And so for auditors, sometimes they will issue what's called a going concern opinion, meaning the financial statements are good, they're accurate. However, we have concerns where this company is going to continue in business. Therefore, you may not be able to rely on some of the judgments used to create these financial statements. And in COVID, this could have been an issue. A lot of companies were struggling during that. Periodicity, this is back to, it's almost like economic entity, but this is the accounting period. What accounting period are we doing? And at the top of every income statement and balance sheet, we're going to have the name of the entity, what kind of statement it is, and then what period is that. So this gets back to timing. And then finally, monetary unit, and using US, we look at the US dollar. Keep in mind, as I said, the companies I operated in, we had 20 to 25 different currencies, but we reported in the US dollar. And so we are fortunate, the accounting rules give you guidance and guidelines on how you translate and convert all those currencies from different financial statements around the world into US dollars. And then finally, we're going to look at revenue recognition and measurement concepts. Is refers to admitting recording information in the financial statements. When it's really sometimes about when and to recognize an item, and a measurement, how much are the dollars amount that we're going to recognize, and then disclosure is very important, because we are going to have footnotes that disclose more information around that. So here's some of the things that we have to think about in recognition. Revenue is a big one. Revenue recognition. And there's just a new, the FASB issued a new standard for revenue recognition just 3 or 4 years ago to provide, some clear guidance on when you can recognize revenue and how you recognize it. And we're going to get to that in a later chapter in Intermediate Accounting 1. So here are the kind of two overriding kind of roles. We want to make sure the earnings process is complete or virtually complete. And we want to be certain, reasonably certain, that we're going to be able to collect cash for this, later. We'll have an accounts receivable, but if maybe the process is complete, but we don't think we're ever going to get paid for it, is that really revenue? And so we may not be able to recognize it. And here's the ASU number 2014-09. So in 2014, this is when the new revenue recognition guidance came out. And, as you would think, recognize revenue when goods or services are transferred to customers. That's a recognizing for the amount they expect to receive in exchange. So expenses, when do we recognize expenses? Number one, if we can relate it to the revenue, we want to make sure we match that expense with that revenue. For example, if we sell a product and deliver it to our customer, the expense of that product, we want to recognize in a special expense, which we'll see, cost of goods sold. And we want to recognize that expense with the revenue. Sometimes for expenses that are more indirectly related to revenue, we're going to expense it when incurred. Think about salaries. We're going to expense salaries when the employees provide their services to us, not when they're paid. And so we want to be very systematic and rational, think neutrality around that allocation to specific time periods. Here's some measurements, and there's what we call a mixed attribute. Some of these win for one type of transaction, and other ones win for a different type of transaction. So we talk about the historical cost. Is a really important aspect of accounting, and I'd like to think about that in terms of property, plant and equipment, buildings and machinery, equipment. We record that and what we paid for it. Why? We use the historical cost. Now, the value, especially land and buildings that the company owns, they may increase or decline in the future. They may increase 3, 4, 4-fold, but sometimes it's hard to get back to the concept statement. It's hard to verify that fair value. If we're not selling it, we don't know. So for property, plant, and equipment, we rely on the historical cost. There's going to be other things we're going to see that we'll look at the fair value. We'll get to that here in a minute. Another measurement is net realizable value. You'll see this concept, especially around things like accounts receivable. It's amount of cash which we think we're going to receive in the ordinary course of business. How much cash are we going to realize from that transaction? For example, accounts receivable, we may know some of it may be uncollectible. That it may become what we call bad debt. So we're going to record accounts receivable at the net realizable value, the amount of cash we expect to collect from that accounts receivable. Now, these last three are really almost more around fair value concepts. One fair value could be the current cost that it would cost to go buy that. Another kind of form of what I think of as fair value is using time value money. What's the present value of future cash flows? And what's the present value? And finally, the fair value, which these could be estimates of fair value, 3 and 4. What will we receive if we sold the asset or transferred the liability today? Now, fair value is in conflict with historical cost, which is more relevant. Well, I would say fair value is a lot more relevant, but for certain assets, is it verifiable? Because let's say we bought a building for $1 million. Let's go down the road 4 years. My boss, the CEO, said, "Hey, have we recognized the value of this building? It's worth $10 million." I talked to someone else and say, "Oh man, it's not worth what we paid for it. The market's down. We'll never sell that at 10 million. I don't even think it's worth $1 million." So you're going to have different opinions, and you can hire different expert appraisers. You're going to get different answers. So it's very hard to get away from the historical cost principle. And I would say, if we could just recognize the fair value, man, we're going to be subject to, is the information relevant any longer? Because it could be subject to abuse. Like I said, the CEO said, it's worth 10 million. So we have a gain. That gain would go on the income statement. Just because we think it's at a higher fair value. But if we use historical cost, it's consistent because it's what we paid for it. Very verifiable. Now, there are things where the codification in the FASB, say use historical costs, property, plant, and equipment being one. There's other place where the fair value is easily and objectively attainable. Like if the company buys stock, equity positions in other companies, and that stock's traded on the New York Stock Exchange. We know every minute of the day what the fair value is. In that case, we could recognize the fair value and changes in fair value. And I think I talked about historical costs in these as well. So fair value is sometimes called the current market value. I wouldn't worry too much about. So you could use the market approach, valuation based on market information. That'd be going to, like for stocks, to New York Stock Exchange. Income approach, which would look at the time value of money, again, the present value of the future amounts that we're going to receive, or how much it costs. So these are some different levels to measure fair value. Again, I'm just going to continue to stress the FASB is moving towards more things valued at fair value because of relevance, but there's been a lot of pushback because are those fair values verifiable? And so again, the FASB does give company for all financial assets and liabilities to measure those at fair value. So you have that choice. Again, I would focus on financial assets because hard assets like property, plant, and equipment are measured at historical cost. So disclosure, there are going to be just tons of supplemental schedules and tables provided with the income statement. And those disclosures are an integral part of the financial statements, and GAAP codification requires you to disclose certain elements. And the most important thing for our users, we want to make sure that we're providing all of the relevant information, not just what GAAP requires, but there's more that we need to let people know about our financial statements. We can do it. We have a place to do it in the footnotes to the financial statements. GAAP is evolving. Do you look at the income statement first, or do you look at the balance sheet first? There are values of both. A lot of people would rather recognize the assets and liabilities at the balance sheet date and let the changes in those hit the income statement. The other approach would be look at what is the right income statement approach and let those changes reflect the balance sheet. And I think you'll see there's some compromises in GAAP that allows both to be right, but at many times there's a compromise. And I would say the one thing that is kind of the saving grace here, and I'll just introduce this one topic for later, and that is what's called accumulated other comprehensive income. Sometimes we'll recognize a liability that's so large and it's very volatile line item that the FASB decided, don't let those changes hit the income statement, because then the income statement will not be relevant. So there's a way to get the balance sheet right. And so we're going to, let's say credit, pension is a good example. Let's say the pension liability goes up by 300 million. It's very volatile because pensions are paid out 20, 30 years down the road. And so every year that pension liability changes by, it can be by hundreds of millions if you're in a large company. Well, what the FASB said is, if you credit that liability, don't debit the income expense in the income statement. We will put it in another section of equity called accumulated other comprehensive income. And that's the purpose of that bucket in equity. And so that you'll see this, now you're in intermediate accounting, you're going to see more references to accounting rules that the balance sheet gets recorded correctly, but that those changes to the balance sheet don't affect the income statement. And so that's another nuance and complexity with intermediate accounting. And with that, again, thank you for your time watching this lecture, and I really appreciate it. And I hope that these intermediate accounting lectures will be helpful to you. Thank you.